12 months ago, the most boring investment in the world quietly did something no other asset class has done. It went up, while stocks were falling, while crypto was crashing. While the headlines were screaming about a recession, the 30-year US Treasury bond did the one thing it has done in every single recession for the last 100 years. It paid you to wait. Most people have never bought one. Most people do not even know they exist. They sound like something your grandfather would have owned. And that is exactly the point. This is the 30-year Treasury bond file. Here is the simple version. The US government wants to borrow money. Instead of going to a bank, it issues a bond. You give the government $1,000 today. For the next 30 years, the government pays you interest. At the end of 30 years, the government gives your $1,000 back. That is the whole thing. The 30-year Treasury is the longest dated bond the US government issues. It is backed by the full faith and credit of the United States. That is not a metaphor. That is the actual legal phrase. The US government has never once failed to pay back a Treasury bond. Not in 1929, not in 2008, not in 2020, never. When you buy a 30-year Treasury, you are making the single safest loan in the history of human finance. And the kicker is, the yield, the interest the government pays you, is currently higher than what most dividend stocks pay. Higher than what most savings accounts paid for the last 10 years. Higher than what most corporate bonds paid. Higher than what most people think is possible for a so-called safe investment. In a world where everyone is chasing the next AI stock, the boring loan to the US government is paying you 5% a year to do nothing. Here is the part nobody talks about. Over the last 100 years, the 30-year US Treasury bond has been positive in every single recession. Not most, every single one. In 1929, when the stock market lost 89% of its value over the next 4 years, long-term government bonds returned roughly 5% a year, positive. While the world was ending, in 1973, when oil shock and stagflation crushed the market, long-term treasuries delivered double-digit returns, while stocks lost almost half their value. In 2008, when the financial system nearly collapsed, the S&P 500 fell 37%. Long-term treasuries gained 20%. Same year, same crash, different result. In 2020, when COVID hit and stocks fell 34% in 5 weeks, long-term treasuries rallied to all-time highs. This is not a coincidence. It is not a fluke. It is not some clever trading strategy. It is the structural reality of what happens when panicked investors flee risk and rush into the one asset class with zero default risk. Long-term treasury bonds are the destination. And every recession in the last century has sent money there. The boring investment that pays you to wait has paid investors to wait through every recession for 100 years. While everything else burned, the treasury holders just kept clipping coupons. The mechanics are simpler than you think. 3 reasons. Number 1, zero default risk. The US government is the only entity in the world that can print the currency it borrows in. If every other borrower in the world failed at once, the US government could still pay its debts. It would not be pretty, but it would be paid. There is no scenario in which a US Treasury bond goes to zero that does not also mean the US. Government has already collapsed, and in that scenario, your stocks, your house, your bank account, none of it matters either. Number 2, duration. Long-term bonds pay you a higher yield than short-term bonds because you are locking your money up longer. That duration also means long-term bonds are extremely sensitive to falling interest rates. When the Fed cuts rates to fight a recession, long-term treasury prices go up significantly. A 100 basis point cut in interest rates typically pushes long-term treasury prices up 15 to 20%. That is a 1-year return in 3 months. Number 3, flight to safety. Every recession, every crisis, every bear market triggers the same move. Investors sell what they can sell and buy what they trust. And the most trusted asset on the planet is the US Treasury bond. The money has to go somewhere. It goes there. These 3 mechanics stack. Zero default risk, duration-driven price appreciation when rates fall, and a guaranteed buyer of last resort crowd in every panic. That is the formula. That is why the 30-year Treasury has paid you to wait for 100 years. Here is the part that should bother you. The 30-year Treasury market is roughly $2.5 trillion in size. It is the deepest, most liquid bond market in the world. And most retail investors own exactly zero of it. Who owns the rest? Foreign central banks. China holds about 800 billion. Japan holds about 800 billion. The UK, Switzerland, Saudi Arabia, Taiwan, all major holders. They are not buying because they think US interest rates are exciting. They are buying because they need a place to park their country's wealth that will not disappear. The US Treasury is the only asset class on the planet that fits that bill at the scale they need. Domestic holders are even more interesting. The Federal Reserve holds about $2 trillion in treasuries. The Social Security Trust Fund holds about $2.5 trillion. Pension funds, insurance companies, university endowments, all major holders. The 30-year Treasury is the operating system of the global financial system. It is what every major institution uses to store wealth safely. The retail investor, you, me, the average person watching this, owns essentially none of it. The quiet rich own it indirectly through their pensions and their insurance products. The visible rich own stocks, real estate, businesses. The boring loan to the US. Government is owned by the boring institutional money that runs the world. And the thing is, you can buy it too, in any amount, starting with $50 through a Treasury Direct account, or through your brokerage, or through an ETF like TLT or EDV. The 30-year Treasury is not just for central banks. It is for anyone who wants the same safe loan the smart money is making. Here is where most people get it wrong. The 30-year Treasury is not magic. It has a real ugly downside that nobody wants to talk about. The same duration that makes long-term treasuries rally when rates fall means they crash when rates rise. In 2022, when the Fed raised interest rates from 0 to 5% in 18 months, long-term treasury bonds lost 35% of their value. The S&P 500 fell 25% that same year. The 30-year Treasury was actually the worst investment of 2022. If you had bought a 30-year Treasury in 2020 at a 1.5% yield and held it through 2022, you would have lost a third of your money. That is not a typo. The most boring investment in the world lost more than the stock market that year. The lesson is not that treasuries are bad. The lesson is that timing matters enormously. Buying a 30-year Treasury when yields are at 1.5% is a terrible idea. Buying one when yields are at 5% is a much better idea. The yield is your cushion. The higher the yield you lock in, the more interest rate risk you can absorb before you start losing money. The current 5% yield is a historically attractive entry point. It is not the highest yield in history. That was 1,981 at 15%. But it is the highest yield we have seen in 15 years. And it gives you a meaningful buffer against future price volatility. This is the trap most retail investors fall into. They buy the 30-year Treasury because they heard it is safe, and they buy it at the wrong time. The right move is to buy it when the yield is paying you to take the duration risk. Today, it is. Tomorrow, it might not be. The same people we have been talking about, the quiet rich from the dividend file, the recession-proof ones from the recession file, they do not own the 30-year Treasury directly. They do not need to. They own it indirectly through every product they already use. The pension fund at your old job, it owns 30-year treasuries. The insurance policy on your house, it owns 30-year treasuries. The 401k at your current employer, a portion of it is allocated to long-term government bonds. The annuity product the financial advisor tried to sell you, mostly 30-year treasuries under the hood. The quiet rich did not have to learn what a treasury yield curve is. They did not have to time the bond market. They have professionals managing their money, and those professionals allocate a portion of every portfolio to long-term government bonds. Always. Without thinking about it. The reason? Diversification. When stocks fall 40%, the bond portion rises. When bonds fall 35%, the stock portion does something else. The whole portfolio does not collapse at once. The boring 30-year Treasury is the stabilizer, the ballast, the thing that keeps the ship from sinking when the storm hits. If you do not have a financial advisor, you can do this yourself. A 60/40 portfolio, 60% stocks, 40% bonds, is the default for a reason. Adjust the 40% toward long-term treasuries when you think a recession is coming. Adjust it back when you do not. That is the entire strategy. It is not sexy. It is not a course. It is a number on a screen that you rebalance twice a year. Here is what to do with a 30-year treasury. Not the panic playbook, the boring one. Number 1, open a brokerage account if you do not have one. Fidelity, Schwab, Interactive Brokers, Robinhood, they all let you buy treasuries directly. You can also use Treasury Direct, the government's own platform, but it has a worse interface and fewer features. Most people use their brokerage. Number 2, decide your allocation. The standard answer is somewhere between 20 and 40% of your portfolio in bonds. If you are young, lean toward 20. If you are close to retirement, lean toward 40. The 30-year treasury should be the majority of your bond allocation, not the whole thing. Mix in some short-term treasuries and some tips for balance. Number 3, decide how to buy it. You have 3 options. Buy individual 30-year treasury bonds directly. Buy a treasury ETF like TLT or EDV, or buy a target date bond fund that handles the duration decision for you. For most people, TLT or a target date fund is the easiest. Number 4, buy when the yield is paying you. The current 5% yield is a good entry point. If yields spike to 6% or higher, that is an even better entry point. Do not buy when yields are at 1.5%. That is the trap. Number 5, rebalance once or twice a year. Sell some of your winners, buy some of your losers, keep your target allocation. That is it. That is the whole strategy. The 30-year treasury is not a get-rich-quick investment. It is not going to 10x in 3 years. It is not going to make you a crypto millionaire. It is not going to show up on Instagram. What it will do is sit in your portfolio year after year, paying you interest, and it will do the one thing no other asset class can reliably do. It will be there when everything else is falling apart. It will be the ballast that keeps your net worth from going to zero. It will be the boring thing that saved you. The people who have 30-year treasuries in their portfolio do not talk about them. They do not post about them on social media. They do not write newsletters about them. They just own them quietly. The same way the people who have dividend aristocrats do not talk about their dividend aristocrats. The same way the people who paid off their houses do not brag about their paid off houses. The boring investments compound quietly. The boring investors stay quiet. And the boring strategy beats the exciting strategy in every single recession for the last 100 years. That is the file, the 30-year treasury bond file. If this made you rethink what the most boring investment in the world is actually doing for the people who own it, subscribe. We open a new file every single week.